Welcome, and thank you for joining us today for the first of 3 webinars in the NAS Investment Solutions webinar series. Today's topic is 1031 exchange, deferring capital gains tax. This webinar will last only 30 minutes because we know your time is very valuable. There will be a presentation from industry expert and president of Exchange Strategies Corporation, Stan Freeman, and then an interactive discussion between Stan and Karen E. Kennedy, President and founder of NAS Investment Solutions and National Asset Services. If you have any questions for the panelists, please submit them with the Q&A feature on Zoom. And without further ado, I will hand this over to Stan Freeman.
Thank you. I'm going to share my screen. Hello, everybody. Thank you for having me, to Karen and her team. We're going to spend some time, a brief amount of time today, talking about the essentials of 1031 exchanges. 1031 exchange is a term that gets used a lot. The 1031 refers to a section in the Internal Revenue statutes that were written quite some time ago in the early 80s. And the main provision of those statutes is that if you conduct an exchange of real properties that have been held for income or investment, according to the rules, that the gain from the relinquished property sale is deferred, sometimes indefinitely, certainly for a long time. There was a question that came in prior to today about can the assets be held in a trust and the beneficiaries of the trust get step up in basis, and the answer is yes, in a properly structured trust. I don't know what that is, but a trust, an estate's attorney would know that off the top of their head. The role of the QI in an exchange, a QI is what my firm, the role that my firm plays, is to administer the exchange in terms of documentation and monitoring the deadlines and participation in the closing transactions, and to be a custodian for the cash. The use of the cash that comes from the relinquished property sale in the 1031 exchange is highly regulated, and it's the job of the QI to make sure that those regulations are adhered to by all parties. There are 4 very basic 1031 exchange requirements I want to just briefly touch on today. Each and every 1031 exchange has the same requirements, and so this is common. The first one is that the same taxpayer must sell and buy. That is, that the owner of the relinquished property is the taxpayer that's going to report the exchange. It must sell the relinquished property and then, according to the rules, acquire the replacement property. So there's only one taxpayer. And you can use LLCs that have the taxpayer as their sole members. They're disregarded for tax purposes. That's fine, but it must be the same taxpayer. And most of you probably already know that if you're a partner in a partnership, that the partnership is a different taxpayer than any of the partners. So it's complicated when there are partnerships involved. But this is a very basic rule that the IRS and all the other state taxing authorities will definitely confirm if you're in an audit situation. The second thing is that the assets must be like kind. These days, the only assets that are subject to 1031 exchange are real property. But real property includes a lot of different things. It includes single-family homes, multifamily, office buildings, triple net properties, farmland, long-term oil and gas leasehold estates, transferable development rights. It also includes, most importantly, properly structured DSTs, fractional interests in other properties. And any of those assets can be exchanged for any other asset that's in that category. So, you don't have to exchange residential property for residential property. You don't have to exchange a farm for farm. You can go and exchange in any of those categories. Thirdly, the assets must be held for income or investment. So there's two things here. The assets must be investment properties or income-producing properties, and that's specifically contrasted with primary residences, which are not subject to 1031 exchange. You can get some relief for primary residences from Section 121 of the Internal Revenue Code, but they are not, it's not something that you can treat with the 1031 exchange. And the other aspect of this is that they have to be held. There is some sort of a holding period. So if you're buying and selling frequently and you're not holding on to these assets very long and you get scrutinized, you may be required to explain why you have an abnormally short hold time, and you may be regarded as a flipper or as holding the assets for resale, in which case your exchange may be in jeopardy. So be very careful about the hold times and make sure that the assets are clearly, unambiguously held for income or investment. The fourth item here is that there are two important deadlines that have to be maintained. The first one is for identification of potential replacement property, and the second one is for the acquisition of of properly identified replacement properties. Both of these deadlines start on the day that the relinquished property is sold. The identification is due on midnight of the 45th day, and the acquisition of replacement property must close on or before midnight of the 180th day. So within 45 days of the sale, you should submit an identification form to your QI that has one of the three rules: the three property rule, the 200% rule, the 95% rule. We don't have time to go into those here today, but most of you probably have used those, and you can read about them on our website or lots of other places. And then once you identify, you have a total of 180 days to acquire one or more of the properties from among those that you identified. Once your 45 days is up, you can't change your identification. You can change it as many times as you want to prior to midnight of the 45th day. But once 45 days have transpired, you're stuck with whatever your last and final identification was. Okay, so same taxpayer must sell and buy. All the assets must be like kind. The assets must be held for income or investment. And you have a 45-day deadline for identification and a 180-day deadline for acquisition. Those deadlines are part of a very basic 1031 exchange timeline. This is what it looks like. This is what every single one looks like. On the first day, day one, the relinquished property is sold to a buyer, and the cash proceeds of the sale are transferred out of escrow into a 1031, a special 1031 escrow account under the control of the qualified intermediary, where they have to sit until they're either returned or used for the acquisition of replacement property. Sometime before midnight of the 45th day, the exchanger must identify one or more potential replacement properties in accordance with the three identification rules that are published in the statutes. If you don't identify within 45 days, then the exchange is over, it fails, and the QI is required by statute to return your cash, and the sale of the relinquished property would be a taxable event at that point in time. Also worth noting is that any property required with exchange funds before the 45-day deadline comes along is automatically deemed to be identified. So that could save you a little paperwork. And then sometime later on in the process, the replacement property is acquired from its seller. The cash proceeds being held by the QI are contributed to the purchase, and title is conveyed directly to the exchanger as a result of that close, and the exchange, or that portion of it, is done at that point in time. So that's the basic 1031 deferred exchange timeline. If you've been around at all, you've heard the phrase taxable boot. This comes up in 1031 exchanges all the time. Boot means, in this context, any kind of property, including cash, which is the common form that boot takes, that's received by a taxpayer in an exchange that is not like kind to real property. Cash is not like kind to real property. And this, dealing with boot, in trying to deal effectively with boot, it's important to remember that there are two rules that you must satisfy in order to defer 100% of the gain from the relinquished property sale. The first one is the fair market value rule that says the fair market value of the replacement property adjusted for closing costs has to be greater than or equal to the fair market value of the sale price of the relinquished property, also adjusted for closing costs. So there's a fair market value hurdle to get over, and it's not or, but it's and the equity in the replacement property purchase must be greater than or equal to the equity taken out of the relinquished property sale. So you have to buy up, you have to have a price that's higher, and you have to have at least as much equity in the replacement as you do as you've taken from the relinquished. And the most common area that people get into trouble and generate boot for themselves is the use of leverage, the use of debt in acquiring the replacement property, and an improper understanding of how this works. It's always possible in an exchange to replace relinquished property debt with replacement property equity, but it is not possible without creating boot to replace equity with debt. And there's a couple of examples here that I just want to walk through. In the top, when you see this hypothetical relinquished property whose fair market value is 900 with no debt, is exchanged for a replacement property whose fair market value is 1,000, also with no debt. There's no boot in that transaction. Next one down, $900,000 relinquished property, no debt, $1 million or $1,000 fair market value replacement property, but $600,000 in debt. That means that only $400,000 of the $900,000 in proceeds from the relinquished property sale has to be used to close the purchase, because there's $600,000 loan. That means that there would be 500 of taxable boot generated by this exchange, because you've replaced equity with debt. And you can walk through the rest of these examples and see that this can be a little bit tricky, and this is the place where a lot of people get into trouble. So watch this carefully. A couple of other things that I see frequently that can result in boot, these are at the bottom of the slide, is an assumption, an incorrect assumption, that the fair market value of the replacement property only need be equal to the gain realized from the relinquished property sale. That's not true. The two don't have anything to do with each other. You need to go back up to the basic rule that says you got to buy up, and you have to have at least as much equity in the replacement property as you take from the relinquished. Same kind of thing. There's people who have gotten into trouble thinking that the replacement property fair market value can be equal to the net equity taken out of the relinquished property. It just doesn't work that way. Those are formulas for generating taxable boot in all cases. A couple of several other sources of complexity, quote unquote, also places where people make mistakes sometimes. We talked about like-kind requirements a little bit ago. Remember that every asset that can be included in a 1031 exchange is real property. It's a very broad category. Single-family homes, multifamily, strip malls, triple net, bank branches and CVSs, farmland, and various types of energy assets, DSTs. Properly structured DSTs are like-kind to real property, so you can sell what you have, buy a DST, sell a DST, buy something else without fear that you're going to make a mistake on the like-kind question. One interesting note, that an interest in a partnership is not like-kind to real property. So if you are in a partnership, a member in an LLC, for example, with other people, and the partnership owns a piece of property, you are not, it's not like-kind to real property. You can't sell your interest in the partnership and acquire real property and have a successful exchange. You have to take steps to get out of the partnership and turn your partnership interest into an undivided interest in the real estate before you can successfully exchange. This is a very big topic, and I just wanted to mention that it's an issue without trying to explain all the various solutions. So if you have this kind of situation, let us know. We'll help you figure out how to navigate it. Another issue that comes up all the time is holding periods. And the reality is that there are very few bright lines in 1031 about valid holding periods. There's a revenue procedure, 2008-16, which says that 2 years is, a safe harbor, quote unquote. And if you hold property for 2 years in certain circumstances, then the IRS is not going to challenge its status as being held for investment or income. But that doesn't mean that property that you've held for less than 2 years doesn't also qualify. And if the properties that we're talking about are income producing, the income is at market, and it's from a third party, if it's a residential property, you're probably in pretty good shape, even if you're only holding it for a few months. If you've rented it to a family member and it looks like the rent is not what it should be in terms of market, then that can be questioned, and perhaps successfully. You got to be very careful in those circumstances. If you're buying and selling properties frequently, and you're reporting a lot of transactions, a lot being 20, 10, 20, 30, big numbers like that, your intent could be called into question as to whether you're holding them for resale versus holding them for investment or income. So you got to watch that stuff. And these are areas where the IRS and especially the Franchise Tax Board, if you're a California taxpayer, have anecdotally been going aggressively after people that don't look good from this standpoint. In general, good facts as it relates to the holding period, market income used in a business, bad facts, unusually short hold time, a history of flipping. If it looks like you're kind of living part-time in a particular property that you're claiming for a 1031, and the IRS detects that you're getting pizza delivered there, or you're paying the electric bill, various things to indicate that it's sometime or a lot of the time a place that you can be found, that's not a good fact. And it sounds a little trite, but those things do happen, so you've got to be very careful with that. Thirdly, we talk a lot with our clients about refinancing of the assets, and without getting into a lot of the gory details, if you are intending to refinance your relinquished property immediately prior to the sale in an exchange, be prepared if you get scrutinized to show that you've got some independent business purpose for that refinance other than just taking cash out immediately prior to the sale in an exchange. And this is an area where there has recently been an increase in scrutiny. On the other hand, if you finish your exchange and you now are entitled to a replacement property, you at that point are responsible for both the burdens and benefits of ownership. And virtually every expert in the field says that it's okay at that point to immediately refinance the replacement property and take cash out if you want. So be very, very careful on the relinquished property side for if you want to do cash out refinancing, but you have a lot more flexibility, a lot more likelihood of success if you do it on the replacement property after the exchange is done. There were a couple of questions submitted about vacation homes and primary residences. This is a tricky area, and conversion to and from rental to residence and residence to rental is possible. The rules get a little bit detailed if you have a vacation rental that has too much personal use, or if you are renting it to family members who are not paying full rent. Be prepared if you get scrutinized to defend this. There is a revenue procedure, 2008-16, the same one I mentioned earlier, that talks about things like renting it for 14 days or more at a market rate to a non-family for 2 consecutive tax years, and not spending any more than 14 days per year in there as a vacation home, or more than 10% of the time that it's rented. So it gets tricky, and the last thing you want to do is back yourself into a corner by making the wrong assumptions. Okay, so these are the 4 primary areas where we see people who are contemplating a 1031 exchange need to be very, very careful about what they're doing. Make sure that if you do any of this stuff, you're very, very careful about documentation, managing the details, making sure you're prepared to defend these things if you are looked at. I just wanted to briefly mention ways that an exchange can fail. I don't mean to be cynical, but it does happen, and you need to look out for these situations. If you don't identify your eligible replacement properties by midnight of the 45th day, then your exchange is over right then and there, and the QI is obligated to return the cash proceeds. You know, this is tough. Even if you do identify, maybe you identify 3 properties, if you lose them all to higher bids, or you can't buy anything that you've identified, you still have a failed exchange. So 45-day identification is an area, especially in some of the bigger cities where competition for the good assets is pretty intense, where there's been, over the last 2-3 years, significantly more exchange failure. If you don't buy things from your list of properly identified assets, then your exchange can fail. In both cases there, if your exchange fails, you're basically paying the tax on the sale of the relinquished property because you've already sold it. You just didn't get enough property identified, or you just didn't buy anything. The other area where people can get into trouble, and where your qualified intermediary is supposed to have your back, is issues associated with constructive or actual receipt of the exchange proceeds. Once the relinquished property sells, the money's supposed to go under the control of the QI, and it's only supposed to be contributed to the purchase of legitimate, validly identified replacement properties. If somehow or another you as an exchanger end up with actual receipt of the funds, or use of the funds for a purpose that's beneficial to you other than the acquisition of replacement property, the entire exchange can be disallowed under audit. It probably will be, actually. This is an area where both the IRS and the Franchise Tax Board, if you're a California taxpayer, have been very aggressive recently. So you're going to watch this. For example, you can't pledge the money as collateral or for any purpose. It can't be borrowed by somebody else. It can't be used to retire debt on a different property. It cannot be used to make improvements to replacement property after the acquisition of the replacement property has closed. It can't be held by an agent of the taxpayer or exchanger or disqualified party. So this is important to make sure that this constructive or actual receipt is not something that you get involved in. And again, all of these examples of failure result in a recognition of the gain on the sale of the relinquished property. It's a taxable event, and you're paying the tax. And I don't have to tell you, between federal and state, if you live in a high tax state and there's still 3.8% Obamacare tax out there, the tax consequences are serious if you end up there. Lastly, I wanted to mention something that it is becoming quite a bit more interesting for a variety of reasons, and that's the concept of a reverse exchange. I'm not going to spend too much time here, but in a reverse exchange, the order of the disposition and the acquisition are reversed, and you acquire your replacement property before you sell your relinquished property. The tax outcome is the same for the most part, but you buy the replacement property, and then you have 180 days to sell the relinquished property. And why would you do that? Well, if something comes up, if Karen and her team have a particularly juicy DST offering that you want to get involved in because the return is good, it's an asset that you really are in love with, and you haven't sold your relinquished property, you can still do it. You can make the acquisition first, and then you have 180 days to sell what you might want to get out of. And that is a very useful technique in a lot of cities where the competition for good replacement property assets is very intense, and you can't have any confidence in the 45-day identification that you're going to be successful there. And it's a lot less risky to acquire first and sell later on. Now, one thing that you have got to be aware of is that you have to have the financial wherewithal to make the acquisition without having access to the cash coming out of the relinquished property sale. But, a lot of people are trying to put money to work, and that isn't an issue. The other thing to be aware of in reverse exchanges is that if you are buying and selling on the basis of ROI or cap rates, reverse exchange gives you an overlapping rent stream for a period of time up to 180 days, in contrast to a deferred exchange where the QI is holding your money and living off the interest that your money is generating. So there's some economic possibilities there that may be interesting to you. If you want to discuss that, let us know, and we'll certainly do that. Okay. So that's it. 1031 exchange is a known, predictable method for retaining equity in safe assets. It's used a lot. As you go down this route, attention to detail is extremely important. The IRS and the Franchise Tax Board and the other state taxing agencies are not benevolent organizations. They're looking for revenue opportunities. Be careful with the details. Make sure you have the right people on your side. And use all the tools that are in the toolbox, including reverses, to exploit good opportunities that come up. All right. Thank you, everybody. That's it.
Thank you, Stan. Well, welcome, everyone. This is the first in our webinar series at NAS Investment Solutions, and I am Karen Kennedy. I'm president and founder of NAS and NAS Investment Solutions. Out of respect for your valuable time, we are committed to keeping this webinar to 30 minutes, and we definitely will not be able to get to all the questions that have been submitted prior to and during the presentation. But I promise you that we will personally respond back to you as individuals after the webinar. So let's take the first question. The first one, hold on here. I'm looking to get into a DST portfolio of 10 properties. Does this constitute a valid exchange if I only sold one? Stan?
Yes. Yeah,
So it doesn't
certainly it
matter
does.
how many are in your up leg. By the way, everyone, the acquisition property is called an up leg, and the sale property that you relinquish is often referred to as the down leg. So those are the terms I tend to use. So Stan, the up leg, it doesn't matter if it has multiple properties in it, it counts as one because it's one DST?
Yes, I think that's right. It's one DST. You have one purchase agreement from one seller, and it represents a portfolio of properties, but you have one asset that you're buying.
Okay, perfect. Next question. Do you anticipate that now we're going to look for the crystal ball, Stan. Do you anticipate that the IRS is going to extend the previously extended deadline for up-leg identification, which is now set at July 15th?
Yeah, it's a good question. All of the 1031 tax attorneys that revolve around the IRS and listen to the IRS are expecting some additional concessions, but they have been expecting those concessions for 4 or 5 weeks now, and there hasn't been anything. So IRS doesn't owe anybody anything. They may do it, but we're waiting, right? And right now it's July 15th. It may be later than that, but nobody knows what they're ultimately going to do.
And Stan, can you clarify from what your understanding is in the way that they poorly wrote this, that they extended the identification period to July 15th, but they did not extend the 180-day requirement from the date of the close of the down leg transaction. So that remains intact. Is that correct?
That's right. So depending on the date that you sold, you have more time to identify, but your acquisition requirement, your acquisition deadline has not changed.
Okay. I'm being
so
told
it's complicated.
I'm being told to wrap up, but I'm going to stick in one more question since it's my comment. Okay. Can you explain what the mechanics are of selecting a qualified intermediary, a QI, and what constitutes proper identification of my up leg if somebody goofed? What should they be looking for when they actually submit the paperwork for identification?
Well, identification, every good qualified intermediary will provide a form that can be used for identification, and it requires you to identify which rule you're going to use, and then to list the properties that are part of the identification. There are 3 rules. There's a 3-property rule, there's a 200% rule, there's a 95% rule. We don't have time to go into the details. Right. But one of the important things about hiring a QI is to make sure they know how to help you figure out which rule to use.
Is it that you have to use the address of the up leg properties by physical street address, or by?
It has to be unambiguous. A street address will work. A legal description will work. If you're buying something and there needs to be a deed or some conveyance document, and whatever is used on that is also got to be unambiguous. So that's the kind of information that you're looking for.
Okay. Okay, Roxanne, back to you.
Thank you, Karen and Stan, and thank you to the viewers for submitting these questions. Unfortunately, we didn't have enough time to answer everyone's questions, but if you are interested in learning more about 1031 exchanges, you can download a free educational guide to 1031 exchanges from our website, nasinvestmentsolutions.com. And a recording of this webinar will also be uploaded to our website within 24 hours. So thank you for joining us today, and we hope to see you at our next webinar on June 30th, the ABCs of DSTs, discussing the popular Delaware statutory trust structure commonly used in commercial real estate investing. So thanks again, and
Thanks,
see you
everybody.
next time.